Hello and welcome. I'm Pallavi Sharma and you're watching Bizworld Weekly, a show where we talk about all that happened during the week that you probably missed out on. From stock markets to economies, we cover everything that matters to you. Let's start with the market check. This week, Indian markets recorded its biggest gain in 2 years. On April 17, Indian equity indices ended on a strong note, with Nifty at 23,851 points and Sensex closing at 78,553.2 points. Top gainers on Nifty were Bharti Airtel, ICICI Bank, Bajaj Finance, Sun Pharma and Eternal, and top losers were Wipro, Hero MotoCorp, Tech Mahindra, Coal India and JSW Steel. All sectoral indices ended in green, with Telecom, PSU Bank, Oil and Gas, Pharma, Auto, Energy, Private Bank rising 1 to 2% each. BSE Small Cap and Mid Cap Index added 0.5% each. Indian rupee ended 31 paise higher at 85.37 per dollar on April 17. Gold prices rose 114 rupees across major cities. In Delhi, prices of 22-carat gold were at 8,935 rupees per gram and 24-carat gold were at 9,746 rupees per gram. China was in the spotlight this week with the US trade war. Well, looks like China was first playing catch and catch with the US, but now it has taken the offensive route and Trump is not liking it for obvious reasons. Earlier, China had said that if US wants a war, it will fight till the end. Now, both sides have massive tariffs imposed on each other, 245% on China by the US and 125% on US by China. The 245% latest tariff was as per the fact sheet released by the White House yesterday. Responding to this, China said that trade wars have no winners. China does not want to fight these wars, but it is not scared of them too. On X, China's foreign ministry spokesperson said this. While imposing the 125% tariffs, China said, and I quote, US will turn itself into a joke by weaponizing tariffs as a tool for bullying. In 2018 too, Trump imposed massive tariffs on China. That time it shook its economy for a while. Now looks like things are different for both the sides. The two countries have steadily decoupled in the recent years, reducing their reliance on each other as per experts. While US manufacturers diversified their hubs from China to other Asian countries too, China, on the other hand, started trading with Africa and Australia for goods that it imports from the US. China's share of total US trade, measured as a sum of exports and imports, dropped from 15.7% to 10.9% between 2018 to 2024, while US's share of China's total trade fell from 13.7% to 11.2%. Chinese exporters like Shein and Temu are still functioning the same, as low-cost goods are sold directly to the customers and there is a tariff exemption on shipments worth less than $800, but that also ends on May 2025. But well, Trump took a step back on tariffs over the last weekend as his administration announced exemptions on smartphones, laptops, flash drives and a host of tech products from reciprocal tariffs. It was to provide relief to the US tech companies reliant on Chinese manufacturing like Apple and Nvidia. But China still went on to suspend exports of rare earth minerals and magnets to the US that are essential for computers, to drones and to military equipment and more. Then it even asked Chinese airlines to hold any deliveries of Boeing planes. Aircraft-related equipment and parts from the US also are being halted. Now, days after Trump's administration announced a tariff rollback, they are saying semiconductor tariffs are coming soon and then slapped China with a 245% tariff. China is the largest source of semiconductors in the world and US is its largest buyer. But looks like the Trump administration knows the pain that tariff could cause. There is expectation of inflation growth in the US and stagflation if this escalates. But China is also losing. The latest 245% tariff is huge. Now, it may impact the Chinese GDP growth as per experts. Brokerage firms have slashed China's GDP growth targets by 0.5% for 2025. For US too, Fed said that the growth appears to be slowing. Stock markets also fell post the announcement from the Fed. Now, earlier, a 25% tariff on steel and aluminium imports was also announced, and Beijing was the world's largest steel and aluminium producer. It is still. With auto tariffs also coming in, China was hit again, being the world's largest car manufacturer. Now, Trump administration suggests that Americans can buy domestically manufactured cars to avoid price increase, but experts are saying that no car manufactured in US relies entirely on American parts. Representatives of tech companies have urged Washington to negotiate trade deals that would lower trade barriers globally. From what it looks like now, China is not looking worried. It is the US that is shaking, but both countries want a deal. China says it is ready to talk. Trump says the ball is in China's court, but someone has to pick up the phone. It's not only the suspension of rare earth minerals and magnets and asking Chinese companies to stop relying on US products. China is going too offensive, and social media is its new weapon. TikTok is flooded, and China is now wooing the American customer directly. In short, it has let the cats out of your luxury bag. If you are on the internet, you have probably seen those reels on Instagram or those videos on X and Threads. Chinese manufacturers and content creators are pitching to the American customer. Buy directly from us. Tariffs are too high. Your Birkin bag is too expensive. The Lululemon tights are burning a hole in your pocket. Then they are saying you can buy directly from the Chinese manufacturers. They are the manufacturers they are claiming. But wait, what about the tag they have? Made in France, made in Italy, etc. Many videos reveal that a bag from a luxury brand is largely produced by Chinese workers there in China. Then they are shipped to the other country for final embellishments. This earns the product the made in France or Italy tag. Well, it's true if the product says made in China, people would not find it very luxurious. And they have gone ahead and claimed that Hermes does the same thing with Birkin bags. A Birkin that costs $38,000 is being sold for $1,400 directly from the manufacturers. Lululemon leggings that sells for $100 in the US is being sold for $5 or $6. Same quality, same craftsmanship, but without a brand name. This is what they're claiming. There are videos on cosmetics from Chanel, bags from Louis Vuitton, shoes from Nike, bands from Cartier, and more. Well, if you are a fashion girly or enthusiast, you already know most of it can be true. But the timing is impeccable because the war is looming, a tariff war. However, some luxury brands have swiftly challenged this. Louis Vuitton says that the products that it has are not made in China. A representative from Lululemon clarified that 3% of its final products are manufactured in China. Despite this, social media is drawn to the idea of undercutting high retail prices of luxury goods. Many of these videos might not be offering genuine products because they could be dupes too. Not only the manufacturers, well, Chinese diplomats also targeted White House spokesperson in a viral post claiming that the red dress that she once wore was made in China. But why is this going online now? And how are they selling these products for dirt cheap to the US customers, delivering it for cheaper rates given the 245% tariff? Well, they have time till May 2025 to sell to American customers directly because the exemption on small shipments up to $800 value is still in place till May. But what's fake and what's real, we don't know, because experts warn that buying directly from these sources could expose customers to counterfeit products or dupes. China has been the epicenter of global counterfeit industry, with US customs seizing $1.8 billion worth of fake goods in 2023 alone. While experts are warning Americans of dupes, they are sourcing these products from Chinese e-commerce apps, and that's increasing. DHgate, a Chinese app, has climbed to the second place in free app rankings in Apple Store. Alibaba, Taobao, and Shein were among the most downloaded apps in the US App Store. Are you buying directly from China now despite knowing some of these products might be dupes? Let us know in the comments. While global markets are seeing some sell-off, Indian markets have seen recovery. This week, Indian stocks rallied after the long weekend as Trump eased tariffs and imposed higher tariffs on China. India became the first major equity market globally to erase the tariff-induced losses. A broader gauge of Asian equities are still down from since tariff announcements were made. An intensifying Sino-American trade war is also shining the Indian markets on the spotlight as India is being seen as the alternative manufacturing hub to China. India is also intensifying its efforts to crack a deal with the US as soon as possible. So some analysts say that the markets might recover from the losses it incurred from the last 2 quarters. The sell-off came amid concerns over slowing economic growth, high valuations, and exit of foreign investors, and that is still continuing. Morgan Stanley has cut FY26 growth for India to 6.1%. As per reports, overseas funds have already sold more than $16 billion worth of local shares equities this year on net basis. But now we're talking about recovery. Some brokerages have come out with their stock picks as Trump tariffs have paused. They say that the domestic-oriented sectors like hospitals, pharma, retail, staples, bank, defense, and power will be key themes to watch. HSBC Security picks Reliance with a target price of 1,590 rupees, TVS Motors with a target price of 2,800 rupees, Shriram Finance with a target price of 810 rupees, ICICI Bank with a target price of 1,610 rupees, Adani Ports with a target price of 1,600 rupees. Ventura Securities recommends HDFC Bank, Fino Payments Bank, Bajaj Finance, Adani Power, Trent, Nippon Life India AMC, Indraprastha Gas, Krishna Diagnostics, P.N. Gadgil Jewellers, NBCC India as stocks to watch. Prabhudas Leeladhar recommends ITC with a target price of 524 rupees, Iris Life Sciences as a long-term bet, IRCTC with a target price of 850 rupees, KEI Industries with a target price of 4,278 rupees, and Triveni Turbine. While these are recommended by brokerages, the trigger is still in your hand. So do your analysis and research before investing in a stock. Bitcoin, a cryptocurrency that experts say was born out of the financial crisis of 2008, was something the world was interested in. Highly volatile, high risk, but it also gave high returns to investors who could time the crypto market. Now it might be the end of cryptocurrency. I'm not saying it. Veteran economist Peter Schiff took to X to declare that Bitcoin was born out of the financial crisis of 2008. Ironically, the financial crisis of 2025 will kill it. Schiff's warning arrives as the markets worldwide are facing volatility following the April 7 equity crash dubbed as Black Monday. However, later Trump went on to pause tariffs for the world except China, but markets are still in red, especially in the US, as trade war with China is still a concern. Well, Trump administration has sure induced a lot of uncertainty in the market with back-to-back and back-and-forth tariffs and rollbacks. But will this end the era of Bitcoin? Well, Schiff says so. He lambasted Bitcoin's collapse down over 27% from January till before tariff easing. He also criticized the newly formed US Strategic Bitcoin Reserve, which lost more than 12% since its launch in March. he argued that selling those holdings for gold would have yielded a 2% gain. Well, Bitcoin has fallen 10% year to date as per recent data. It was in red on April 16 too at around $83,458. The market cap was at $1.65 trillion. This came as tech stocks witnessed a sell-off. Trump banned H20 chip sales in China. Now, analysts say that crypto markets strongly react to the movements in tech stocks. Experts say that at current levels, Bitcoin faces resistance at $87,200 while support stands at $83,000. Now, the market, however, is volatile. Trade war between US and China intensifies, which also impacts the tech stocks. Now, tariffs are also coming soon on semiconductors, the administration is saying. What are your thoughts on this? Let us know in the comments. Do you think Bitcoin will end in 2025? While the world is worried about a trade war, Russia's ruble has become the best performing global currency as dollar is weakening. It has posted the year's strongest gain against the US dollar and outpaced the traditional safe haven too. It has outpaced gold. The ruble is strengthening and it has strengthened 38% versus the dollar on over-the-counter market since beginning of this year as per Bloomberg data. While the dollar is struggling, reeled from mounting pressures caused by Trump's escalating tariff wars, Russia's currency has been strong and standing tall due to the factors unique to the country like record high local interest rates. This is because, unlike other markets' currencies, ruble is not facing any pressure from capital outflow caused by global investors retreating from riskier assets. Experts say that the capital controls have highly shielded Russia from this. Russia has curbed the demand for foreign goods, leading to reduced imports and more foreign currency. So it has also been selling foreign currency, and this has strengthened the ruble. Domestic factors are the reason for ruble's rise against the dollar too, even as sanctions are imposed by the West since the invasion of Ukraine. But it is not all good. There are challenges too because oil prices are dropping internationally. So the price of Russia's flagship Urals crude grade tumbled and is close to $50 per barrel for the first time in 2 years. The global demand might fall further as per OPEC, and it has also cut its forecast. So Russia's economy is highly dependent on energy sales. As per reports, if the global demand further decreased, demand for Russian energy will also decrease, causing pain for the Russian economy. There is also a labor shortage in the country, so Russian businesses have to pay more for labor, which is also a problem. Inflation has been rising above 10% and the interest rates have been hiked to 21%, with Bank of Russia maintaining an ultra-hawkish monetary stance. But the Russian economy might just be okay with all these pain points because it has seen worse. However, the dollar is in pain. Dollar hit 6-month low at the start of this week because of Trump's back and forth tariffs. Traders are flocking to gold from dollar assets amid uncertainty. Gold has climbed 23% year to date. Still, Russia's ruble strengthened even more than gold. And analysts say that supportive factors for ruble are likely to persist in the near term. WhatsApp and Instagram, two widely used platforms in the world, both owned by Mark Zuckerberg's Meta. But the ownership of the two apps and the future of the two is uncertain, because it looks like Meta could be forced to sell Instagram and WhatsApp if it loses the landmark trial that just started in the United States. Let's understand the situation in detail first. The US Federal Trade Commission is accusing Meta of buying Instagram and WhatsApp over a decade ago to neutralize its competition. The acquisition is in line with Zuckerberg's alleged directive of 2008 that says it's better to buy than compete. In 2012, Facebook bought Instagram, and emails read out in the court show that Zuckerberg was worried about Facebook's performance while Instagram was growing rapidly. Before this, he used to buy startups and close them down after retaining talent, but he continued to run Instagram as a separate app. 2 years later, he bought WhatsApp and ran that also as a separate app. Facebook purchased Instagram for $1 billion and WhatsApp for $19 billion. However, Meta has denied the claims and called the case a weak lawsuit that quote-unquote ignores reality. It says that there is plenty of competition from other social media companies too, but FTC argues that there are only two competitors to the app, Snapchat and Mewe. Zuckerberg argued that Meta has only made Instagram better. He also, during the trial, told the prosecutors that he wanted to buy Instagram because of the camera technology, but as per the emails and messages from 2012, it shows that Zuckerberg talked about the importance of neutralizing Instagram. He said in his email, and I quote, "In the time it has taken to get our act together on this, Instagram has become a large and viable competitor to use on mobile photos, which will increasingly be the future of photos." He then in another email said, "We are also far behind that we even don't understand how far behind we are. I worry that it will take us too long to catch up." Reportedly, he also knew about this antitrust trial concerns may reshape the business in 2018 when he warned his executives of the possibility of a sale. In an email he wrote, and I quote, "As calls for breakup, the big tech companies grow, there is a non-trivial chance that we will be forced to spin out Instagram and perhaps WhatsApp in the next 5 to 10 years anyway." Now you may be wondering, why is it important if Meta keeps the apps or sells it? If FTC wins the lawsuit, Meta could be forced to sell both the apps. While this may not have an immediate effect on how we use social media now, experts say that in the long run, it could make social media easier to regulate. It will also depend on who purchases this app. Losing Instagram could be catastrophic for Meta too. Reports say that Instagram will generate $37.13 billion this year, which is little over half of Meta's US ad revenue. As per Bank of America's estimates, Instagram has generated over $50 billion in advertising revenue in 2024. As per reports, Zuckerberg has been lobbying the US president and White House officials to settle the case. But it also takes a lot of time for antitrust corporate breakups. Meta could appeal if any decision is in favor of FTC, and the decision could overturn. Even if it wins, who will buy the giants? And even if they do, will it remain free? Is the question. What do you think? Let us know in the comments. A 13,500 crore rupees scam, fugitive businessman and absconding diamond jeweler Mehul Choksi has been arrested in Belgium. The arrest took place last weekend when Indian agencies including CBI and ED submitted an extradition request. Mehul Choksi is the main accused in 13,500 crore rupees scam, the Punjab National Bank fraud case, along with his nephew Nirav Modi. Both of them are accused of using fake LOUs or letter of undertaking to obtain foreign credit from Indian banks. But Choksi left India in early 2018, just before the fraud came to light. He secured citizenship of Antigua and Barbuda through their citizenship by investment program. Reports suggest that Choksi obtained Belgian residency using fake documents where he shifted a year ago. There are claims that he was looking to relocate to Switzerland for further treatment. In 2017, Choksi acquired Antiguan nationality. Then in 2018, he fled India, and before settling in Antigua, he traveled to USA. In 2019, his nephew Nirav Modi was arrested by the Metropolitan Police in London. Later, in March 2023, Interpol revoked the red notice against Mehul Choksi, which is a request to locate and provisionally arrest a person wanted for prosecution or to serve a sentence. In 2024, Mehul Choksi relocated to Belgium from Antigua along with his wife. In early 2025, reports suggested that Mehul and his wife were considering to settle in Geneva, Switzerland. Later, in February 2025, Choksi's legal counsel informed a special court in Mumbai that he is currently in Belgium, undergoing treatment for blood cancer, and ultimately in April 2025, Mehul Choksi was detained from a hospital in Belgium where he was reportedly undergoing his treatment. But what did he actually do? Well, he is the main accused of one of India's largest financial fraud, PNB scam. The scam involved fraudulent transactions of approximately 13,500 crore rupees. Both Modi and Choksi allegedly manipulated the bank's systems to obtain fraud letter of undertakings. These LOUs were used to secure overseas credit for Choksi and Modi's companies, Gitanjali Gems, Diamond RUS, Solar Exports and Stellar Diamonds, which were later found to be shell companies. Now, the LOUs were issued in violation of Reserve Bank of India's guidelines and were not recorded in the bank's core systems. The Enforcement Directorate or ED has alleged that Choksi and his firms cheated PNB with the help of corrupt bank officials. He obtained the LOUs without following prescribed banking procedures. That's what ED said. Now, the scam led to a massive loss to the bank. The CBI and ED filed 3 charge sheets against Choksi till now, detailing the criminal conspiracy, money laundering and embezzlement. After Choksi's arrest, the whistleblower of PNB scam, Hari Prasad SV, said that the extradition might not be easy because his wallet is full and he will employ the best lawyers to escape the extradition. Hari Prasad had first raised red flags about the scam in a letter to the PMO in 2016, flagging suspicious entries in balance sheets and warning a potential large-scale fraud. As per reports, Choksi's legal team will appeal for bail on the grounds of his ongoing treatment of blood cancer. Now, meanwhile, India is preparing for the extradition, but the question is, will the extradition take place smoothly this time? We'll see. The deadline is approaching for the US on a big order signed by Trump on the day he took office. There is a speculation that Trump administration might invoke the Insurrection Act of 1807. So discussions on whether martial law could be declared on April 20 are going on in the US. Now, these two terms are triggering confusion and concerns across the country. So let's understand them in basic language in a way that a 13-year-old would also understand. First, what is this order? Trump signed an order proclaiming a national emergency on US-Mexico border. One of the clauses in the order tasked Secretaries of Defense and Homeland Security with presenting a comprehensive report within 90 days detailing the condition of the southern border and suggesting any necessary steps to secure a total operational control. Now, this 90-day deadline ends on April 20th, which means that the report will be submitted on April 20th. Now, what's important is that the directive specifically mentions the Insurrection Act of 1807 as a possibility. Now, what is this Insurrection Act? This is a federal law that has been around for more than 2 centuries. It empowers the president to send active military units and National Guard within the country in situations like a civil war or a breakdown of a local government. Now, this is to maintain law and order in place. But the ultimate power remains with the state or the local government. They are just taking help from the military to stop violence. On the other hand, martial law is when the army of a country, instead of the police, controls an area during a time of trouble. Here, the military takes over and runs things instead of the police or the government leaders. Under this, the civilian freedoms might be limited too. So basically, difference is that the military takes full control over day-to-day functions in case of a martial law, and in case of an insurrection act, the military only assists the local government, and it is not necessary that the military will take full control of everything under this. Now, concerns are that if department heads recommend invoking the act, Trump could gain even more authority supported by the military. It is still a speculation, though nothing has been confirmed yet. Because even if Trump has the authority to invoke the act, doing it would set off a firestorm of legal and political controversy. So until there is an official statement, nothing can be said, but it is necessary to know what both of these terms are, the martial law and the Insurrection Act of 1807, before we assume anything. Trump's new target is Harvard. Yes, the same Harvard University, one of the world's finest educational institutions. Trump's demand was simple. He said surrender core academic freedoms or risk losing federal support. The university said no. So Trump froze $2.2 billion in grants to the university after it defied the government's demand over campus protests. The White House also has reportedly frozen $60 million in contracts to the university after it said that it would not comply with the demands to curb campus activism. Trump has also threatened the school that he would revoke its tax-exempt status. It happened with another Ivy League too, the Columbia University. It accused the school of failing to curb anti-Semitism on campus. So that answers why part of Trump's action. He called for a broad government and leadership reform at the university and changes to its admissions policy to curb anti-Semitism activities. Now, it demanded the school to audit views of diversity on campus and stop recognizing some student clubs and ban face masks. Key demands from Trump were governance and leadership reforms, merit-based hiring reform, merit-based admission reform, international admissions reform, viewpoint diversity in admissions and hiring, reforming programs with egregious records of anti-Semitism or other biases, discontinuation of diversity, equity and inclusion or DEI, student discipline reform and accountability, whistleblower reporting and protection, and transparency and monitoring. Now, the impact of the fund freeze will not bankrupt Harvard, but it will strike key areas like grants in medicine, public health, science, and some student aid programs supported by the federal funds. Innovation labs and collaborative research efforts with agencies like NIH and the Department of Energy could also be stalled. That won't stop the university from functioning though, because Harvard's financial power lies in a massive endowment valued at approximately $53.2 billion as of 2024. Now, this is managed by the Harvard Management Company, and it functions like a global investment firm with stakes across hedge funds, private equity, real estate, and public markets. Each year, the university withdraws about 4.5% to 5% from the endowment, which covers 35 to 40% of its operating budget. What do you think of this? Let us know in the comments. London. It was once a wealthy man's dream, the favorite destination of the wealthiest people in the world. Now, millionaires are ditching the city for other destinations, particularly in the US and some parts of Asia. As per the world's wealthiest cities report published by advisory company Henley and Partners and data intelligence firm New World Wealth Record, around 11,300 millionaires have left London in 2024. 11,300. That is a drastic number. It now holds only $215,700 billionaires, leaving it behind Los Angeles and kicking it out of the list of top 5 wealthiest cities in the world. Millionaires leaving London is a part of a broader trend based on combinations of economic, political, and social factors. One among the major reasons why millionaires are leaving London is increasing tax burden. UK has the highest tax rates among the countries in the world, particularly in areas like real estate taxes and capital gains. And real estate is what people invest in the UK. High net worth individuals are sensitive to taxes and they seek regions with less strict tax terms under which they can retain and grow their money. The decision of UK to leave the EU has far-reached effects on the country's economy and international business scene, and so the uncertainty surrounding trade agreements, loss of free movement of labor, and the disruption to supply chains made London less attractive for business owners. Brexit has also damaged the role of London as an entry into Europe. Second reason is US and Asian dominance in tech industry. Singapore, Silicon Valley, and other leading tech hotspots are the new points of wealth creation, and that's where the wealthy want to be. The growth of these tech hubs are attracting talent, capital, and wealthy people from traditional finance centers like London. UK's estate duty and capital gains are the two highest in the world as per reports. These taxes discourage HNIs from staying in UK, especially when there is better low tax and tax-free options like Dubai, Switzerland, and Singapore. Lastly, the stock market dominance has also shattered. LSE, or the London Stock Exchange, which was previously the global financial behemoth, but its dominance has now declined worldwide. As per recent reports, LSE is now ranking 11th globally in terms of market cap. It is no longer the top attraction for foreign investors and wealthy individuals. Now the new hub cities like Frankfurt, Dubai, and New York, which offer robust financial services, good regulatory climate, and reduced tax rates, attracting global investors and high net worth individuals. So London is now losing a lot of millionaires. That's all for the week. Markets will be closed in India for Good Friday on April 18. So I will see you next week. Take care and stay tuned to ET Now for more such news and views.
If you like this video, then like, share and subscribe to ET Now.